Hello folks, Brandon Chapman with today for a Monday video for TheoTRADE. It's December 11th, 2023, and if you look at today's activity in ES, you see kind of a big gap today in the ES. A lot of that's a result of a contract change event, but boy, you look at just SPY, it'll kind of take out that gapishness, and what you see is a higher close still as we open up just slightly below Friday's close, and we rally up. We're to nearly 0.39% on today's session. So what's going on with the market? We continue to bleed higher. We continue to open lower on the open and then rally towards the close, finishing marginally higher for 3 consecutive days here. And again, we're testing brand new, fresh 52-week highs in the S&P 100. And again, what is going on here, right? So we look at today's topic is the next pain trade domino about to fall? Now, if you know anything about pain trades, it's basically when investors or traders are typically moving in one direction, a particular industry or market or theme, and then it kind of blows apart. So for example, most recently, Treasury bonds, right? It was the short, it was the bond bear. We continue to sell treasuries, sell treasuries, sell treasuries, until eventually we came to the realization the Fed is not going to raise rates anymore. And we began to see the reversal in that. And so this has been a pain trade of sorts for the bond bears. So what is the next pain trade that's going to happen in the market? And when is it going to happen? The next domino may fall in this pain trade, and this may create some downside pressures in the S&P 500. And what is the catalyst? Well, we might use Wednesday's FOMC meeting as a catalyst for additional downside. So for example, we go back to one of the last meetings here in July, the 26th, the 27th marked the high, and we had a decent correction out of the market. If we measure that from high to low, from peak to trough, we click on the high, we go down to the low here. It was around a 5.78% move lower. Can we start to see that a similar catalyst as what we saw? And I realize we're up against kind of the Santa Claus rally going into the end of the year, the seasonal trends. Certainly this has gone well beyond what you might have expected. But as we look at volatility, so we'll look at VIX3M plus VIX. We'll look at the term structure of volatility today. Again, it's been this way now for a couple of weeks. We're above 1.2, meaning the market is pricing significant volatility just around the corner in that 3-month volatility window. So usually when this gets north of 1.2 or the 3-month VIX is 20% higher than the spot VIX, we're usually looking for a 5 to 10% correction in the next 3 to 4 weeks, which puts us into the end of the year. And again, we have a potential catalyst here, again, with the Fed fund statement on Wednesday. So as we go back to the S&P, we'll just bring up the SPY here. What you'll see is that what's been the drivers for the market. I mean, certainly initially we had this move based on the Fed's going to hold. They're not going to raise rates anymore. We saw the 10-year Treasury catch a bid, and that trend reverse. But this last gasp here in the market was certainly kind of a result of pricing in rate cuts early next year. And recently it was as early as the March meeting. And something I posted on Twitter earlier today. But if we look at the March meeting right now, I'm just going to refresh this page to see what the current, like up to the minute numbers are for March. But for March, again, we were pricing close to a 60% probability of a rate cut. Right now, we're basically pricing in about a 43% chance of a rate cut. And again, this has been a big shift. If we look down here in terms of the probabilities, it wasn't too long ago, a month ago, we're talking about a 12% chance, a 51% chance a week ago, 43% chance yesterday, 41 today. We're seeing is we were north of 50% probability of cutting in March, and now all of a sudden that's been taken off the table. We look at May. Has it changed for May in terms of the expectation? Well, for May, we're still pricing in, again, a 49 plus 24. We're basically talking about a 75% chance of a rate cut in May. So we're pushing it out. And again, as we look at the numbers here, just a week ago, 45 and 36, we had a 36% chance. In fact, add that to the 4% there. We had a 40% chance of a 50 basis point cut by May. Now we're just looking at basically a 75% chance of cutting at least a quarter point. So right now we're seeing some of the luster come off of the probabilities that the Fed is going to ease next year. And with the jobs number on Friday, with the markets testing new 52-week highs, does the Fed in its meeting, in its statement, are they going to be more on the hawkish side of things? And so we'll have to see. Again, we're at a very pivotal point for the market where skew, after being broken for 4 or 5 days, is finally back intact here. We're at 134. The market is pricing in a larger downside potential here relative to the upside. But with that, you get the high frequency of small up days, which is exactly what we've seen over the last several weeks, despite the fact we've had with this high skew level, despite the fact we've yet to see the downside potential. When you start to couple what's happening with the volatility markets, the 3-month to 1-month VIX or VIX futures compared to the spot VIX, you're seeing over this time frame right here as the market's just eking out a very small amount of relative gains, we're beginning to crack open the downside expectation of high back month volatility or 3-month volatility relative to 1 month. Or if you want to use the product depth here, /VX, just take the front 2 contracts, just take a 30-day weighting or a straight average. In this case, we could say, 15.25, and compare that against the spot VIX and see what premium there is. Spot VIX is 12.6. It basically gives us 3 points divided by 12.6. We're well north of 20% higher if we look at the VIX futures relative to the spot VIX here. So the market, despite its bullishness, despite the fact we keep eking out small gains day after day here, we're still pricing in significant downside potential. And so we're trying to think about what's the next shoe to drop. Well, if we look at some of the bigger movers of the last few days, Intel's an example, right? Big move today. This was a trade I talked about on Thursday with members. We saw some call activity. I discussed a trade idea with this breaking out towards $45 on Intel. Again, but Intel's up nicely today. If we look at Micron had a big bounce today. WPC. Oh, come on. NXPI. Long call activity today approaching recent highs. Even stocks like AI have not exactly seen the same boost, but Google has, right? Google and their release of Gemini, or their discussion of Gemini on Thursday, led to a big bounce here. We're kind of fading back. But a theme that I talked about last Thursday with our members was looking for short-term strength in semiconductors specifically, and that has played out. And so the question is, what trade is going to become the next pain trade? Are we going to see the monsters of tech, your Apples, your Amazons, your Googles, for example, your Microsoft? Microsoft is kind of my top pick for a pullback going into the end of the year. We're pausing right now. Do we refresh or do we break through the bottom? So is it monsters of tech, or is it the surrounding AI theme? So for example, today, Snow, S-N-O-W. It's made a huge move here. We're just kind of breaking through, or very close to breaking through resistance today. We had above average volume. There was significant call activity on the December 200, but December is about to expire this week. Again, do we try to goose things going into a triple witching in the market where we could see a big reversal and a big time FOMC statement this week that could create volatility? Does the technology and the surrounding kind of short squeeze, does it reverse and become the next pain trade? Is it the monsters of tech? Is it real estate? Real estate's had a huge boost of late as yields have come in. Stocks like, for example, today, Redfin had a bearish roll higher in terms of the puts. Rocket Mortgage, right? This had a huge boost. High short interest, big move here over the last few weeks, corresponding with that short squeeze that's been persistent in the market since the lows. Today in Rocket Mortgage, there's again a December expiration out here. Looking at the $10 strike price, we go up here, we look at the chart, $10 right about here. Do we start to see a reversal? Now, what's going to be a catalyst? Well, probably movement in the 10-year Treasury yield, which kind of gapped open this morning. Treasuries kind of got bid throughout the day. Do we start to see yields start to creep up? Again, that's going to help kind of reignite a pain trade in the technology space, in real estate, if yields start to rise. Today we saw, if you look at GLD, the dollar strengthened today. Gold was down nearly 1%. And so with the market, up 0.4%, this is a bullish day for the market. If we figure that dollar is probably up 1%, S&P is up 0.4%, that means the market's up nearly 1.5% today, but the strength in the dollar is masking it over. If we look at the dollar/JPY, the dollar yen, again, rumors that they're going to walk away from NERP and some of their bond buying, normalized policy, and that kind of evaporated over the weekend. Again, this was kind of indicating, man, are we going to start to sell U.S. assets, get dollars, convert to yen, reverse that carry trade, and all of a sudden, what happens? They put it back on here the last couple of days. So watch the yen. This could create some big movement in the market, in particular if this carry trade really starts to unwind, given the very dovish nature of the Bank of Japan. So watch the dollar and yen. One of the trades that have done well the last week is gambling. We're talking about casinos, travel related stocks like CCL, which is a high beta name. And we've looked at this indices before in this video, but SPHB has continued to toe the hill here. CCL is one of the top holdings in that. Do we start to see a reversal in travel? Well, guess what? Last week, stocks like Wynn on Friday was an idea to walk through with our members. It's up 2.15% today. Caesars Entertainment, we got the pullback here. Got a little bit of a bounce on Friday. No follow through today. But this was a December, if we go to the December expiration here, out here at the 47 strike. So again, is this the next kind of last gasp here, right? Caesars, PENN Gaming in the mix here as well. Big move today. PENN was a December 25.50, which is basically where we finished here. And also if we look at China, right? China's been very disappointing. We've had major pullbacks here. I've seen bullish option activity all the way down. But on Thursday, it looked like, we're starting to see a little bit of a turn. So I decided to really make it a focus and a trade opportunity. And today, despite Friday's decline, today we're seeing a little bit more of a bid coming under FXI. And on FXI, I believe it was a roll. Yeah, it was a roll from the 24 calls for December out to December 29. So if we come in here, we look at the time and sales. You'll see kind of just this as a spread here, this extension of the time frame, right? We're selling the 15 Ds 24s, buying the 29 Ds 24s. Again, just extending the time frame. That's about a 16-cent debit. Again, $26. Again, $24. Sorry, $24 is right here. So if we can get a breakthrough 24, could create a little bit of a lift here in the price. Looking for this to kind of retest maybe 26, maybe back to 27. So watch China, especially if the dollar starts to reverse and starts to weaken here. That would certainly help gold, help Chinese stocks. Again, very oversold. Looking for areas where there might be value. And so again, if we're selling some of the hotter areas, what are some of the cooler areas? So certainly FXI is one of those stocks. SBUX is catching a bid today, kind of coming off the lows. Volume was about average, but we look at this kind of downward move here. Let me bring up the fib retracements, and what you see is that we can see a third to half to maybe 2/3 retracement that would get you back to 103, back to prior highs here. So again, we kind of came off our highs just a little bit, but 103 maybe back to 107.50 could be a possibility. If we look at today's trade in SBUX, we're looking at a December expiration and out here at the 102 strike price. So again, 102 gets you where? Right close to in between that 50 to 61% retracement as a potential near-term target, but it's also a gamma level. We start to break through that, may push the stock quickly back to prior highs. Well, if we look at the potential trade here, 15 December is probably a little short. If we go out to 19 Jan, notice that the volatility is rising as you go out of the money. Now, again, we're only talking about a potential target 105 to 107.50. But what if you buy the 100 at 18.29% implied volatility and sell the 105? Now, again, there's not a lot of edge in that, but there's no real negative. The volatility is very, very similar in here. So again, there's no kind of advantage, but there's no detriment. So if we right click here, just buy a vertical, it's pricing at about $1.24. So it's about a 50-50, 1-to-1. And again, you just need this stock to get to 105 plus. And you start to get at 105 up in here, you probably have a chance to close it at a reasonable kind of 50 to 70% gain, even probably before that 105 level. So something to look at here in SBUX. If you want dollar increments, you're probably coming here to the 12th of Jan. We're looking at the stock currently at 98. What about buying in 99 and selling a 105 up here? So again, very similar volatility, or you could push a little bit more, 101, buy the 101, sell the 103. There's a little more of a volatility edge, and you only need this thing to get to 103-ish. Okay, so again, that's probably maybe a more reasonable 101, 103 here. The delta on that 101, it's a little low here at 32. I usually like to target the 40, but this skews a little bit against you as we get out here. So shifting it out maybe a little bit further out of the money lowers the cost, and again gives you some decent upside here if we were to get towards 105 as a target on SBUX. Also today in Exxon, so we're trying to find areas of opportunity. So we're talking about pain trade on the downside, looking for rotation out of what's worked over the last number of weeks. Again, looking for bearish trades and stuff like CCL or IYR, that kind of stuff, real estate. Now we flip it to the bullish side in Exxon. We actually broke support. We're retesting our lows from March back here of this year rather. We could see a little bit of a move towards 105. Now I would have thought that back here on the 4th, but we've broken lower, which only sets this up a little bit better for just a reversal, right? Just a bid going back to prior highs, or maybe even stopping short about 102.50. The trade today in Exxon was a December expiration. Flip this here. At the 99 strike. So some buying in here at the 99 for this week. Again, kind of creates this level around the 99. If we can push through here again, 102.50, maybe 105. And so we get out here again, looking at an upside call spread for a 19 Jan. And you can see we got 250 and then breaks out to $5 increments. If you want to keep it tighter, you could go here to the weeklies where we've got dollar increment strike prices. And so we got 99.62. What about the 100 at 23.6% implied volatility and the 102? Well, that's going to be a little bit more expensive here, right? What's the possibility here? 102, 105? Well, if we get out towards that level, 103, 105, notice that the volatility levels off quite a bit. So 102, 104, about a 0.5% difference here. But the idea is you could get in for about 66 cents on a $2 wide spread, buying the 102, selling the 104. And all we need is the stock to get up into this area here on Exxon in the next, 32 days. Seems like a pretty reasonable expectation off of this low level in Exxon. So as we look at some varied opportunities here, again, we're watching very, very succinctly to see what's the market's going to deliver after the Fed statement. Does the Fed step in it? Does Powell put his foot in his mouth as is normal? Or do we start to see the market continue to accelerate to the upside, which right now the volatility markets aren't exactly pricing in? Maybe we just limp into the end of the year. We start to sell off early next year. Or again, Wednesday may be a catalyst going into the end of the week to see this start to reverse, as maybe some of the momentum caused by expectations of the Fed holding rates or cutting rates early next year starts to fade by a hawkish statement by the Federal Reserve on Wednesday. Anyway, folks, we'll leave it there. Have a great one. We'll see you back next week.